What if one of the biggest business opportunities in America has been sitting in your laundry room this entire time? Every week, millions of Americans toss dirty clothes into a washing machine, pour in a little detergent, press a button, and move on with their day without giving it a second thought. But behind that simple routine is an industry worth more than $10 billion a year, generating enormous revenue from a product most people never even notice. When people talk about starting a business, they usually think about restaurants, real estate, tech startups, or the latest online trend. Almost nobody talks about laundry detergent. It is one of the most ordinary products on the planet. It sits on grocery store shelves. It lives in utility closets. It gets purchased over and over again without excitement, without headlines, and without attention. Yet that is exactly what makes this industry so interesting. Because while flashy businesses fight for attention, detergent companies quietly sell products that households need every single week. And that simple reality has created a massive market hiding in plain sight. One entrepreneur who recognized this opportunity is Michael Carter. Instead of chasing a trendy business model, he focused on a product that people already buy regardless of the economy, regardless of social media trends, and regardless of what happens in the stock market. Today, his company operates inside one of the largest consumer product categories in America, serving customers who may never know his name, but continue buying his products month after month. The question is not whether people need detergent. The question is who is making money every time those bottles leave the shelf. And once Michael started looking closely at the industry, he realized something surprising. The biggest opportunity was not where most people thought it was. So how does a seemingly boring product become the foundation of a highly profitable business? And why are so few people talking about an industry that almost every household contributes to every single week? What makes this category so powerful is not the product itself. It is the behavior behind it. Think about how often people buy a television, maybe once every several years. A refrigerator might last a decade. Even a car can stay on the road for years before it needs to be replaced. But laundry detergent is different. It gets used, runs out, and gets purchased again. Then the cycle repeats. Week after week, month after month, year after year. That creates something every business owner dreams about: repeat demand. In the United States alone, hundreds of millions of loads of laundry are washed every single week. Families wash school clothes, work uniforms, towels, bedding, athletic gear, and everyday clothing. Apartment residents use it. Homeowners use it. College students use it. Hotels use it. Laundromats use it. The customer base is not a niche. It is practically everyone. When Michael first began studying consumer products, he noticed that most entrepreneurs were chasing products people wanted. Very few were focused on products people needed. That distinction changed everything. Wants come and go. Trends appear and disappear. But clean clothes remain a constant part of everyday life. That means demand is remarkably stable. Even during periods when consumers cut spending, detergent rarely disappears from the shopping list. People may switch brands. They may look for better value, but they still need to wash their clothes. The more Michael researched the market, the more he realized that the real strength of the business was hidden inside simple economics. Customers often stay loyal once they find a product they trust. Many households buy the same detergent for years. Some even pass brand preferences from one generation to the next. That creates a powerful advantage because acquiring a customer once can potentially lead to years of repeat purchases. Yet despite all these attractive characteristics, most people never consider entering the industry. They assume the market belongs entirely to giant corporations with massive advertising budgets and endless shelf space. On the surface, that assumption seems reasonable. But as Michael dug deeper, he discovered something surprising happening beneath the industry giants. A growing number of smaller brands were quietly finding profitable opportunities that the largest players were not focused on. And that discovery completely changed the direction of his business journey. The assumption that only giant corporations can succeed in this market is exactly what keeps most entrepreneurs away from it. When Michael first started researching the space, he expected to find a handful of dominant companies controlling everything. And to some extent, that was true. Major brands occupied enormous shelf space in grocery stores and big box retailers across the country. Their marketing budgets were larger than the annual revenue of many small businesses. Competing head-to-head against them seemed impossible. But the deeper he looked, the more he realized that the market was not a single battlefield. It was thousands of smaller opportunities hiding beneath the surface. Instead of trying to sell to everyone, newer brands were targeting specific customer groups with specific needs. Some focused on environmentally conscious consumers looking for plant-based ingredients. Others built products designed for sensitive skin. Some created highly concentrated formulas that reduced packaging waste. Others focused on premium fragrances, subscription services, or direct-to-consumer sales. Suddenly, the competition looked very different. These smaller companies were not trying to beat the giants at their own game. They were creating entirely different games. That insight became a turning point for Michael. He realized that consumers were not simply buying cleaning products. They were buying convenience, trust, quality, sustainability, and sometimes even identity. Two bottles sitting side by side might perform a similar function, but the story behind the product could influence purchasing decisions just as much as the formula itself. As he studied successful niche brands, another pattern emerged. Many of them did not own massive factories. Many did not start with huge teams or millions of dollars in funding. Instead, they focused on building a strong brand, understanding a specific customer, and delivering a product that solved a clear problem. Some started online. Some sold through local retailers. Some built loyal audiences through social media and word of mouth. For Michael, this was the moment the opportunity became real. He no longer saw a market controlled entirely by billion-dollar corporations. He saw a collection of underserved customer segments waiting for better options. The question was no longer whether a smaller company could enter the industry. The question was which customer group he could serve better than anyone else. And once he found that answer, he decided it was time to stop researching and start building. Once Michael identified the customer segment he wanted to serve, reality arrived quickly. Researching a business and building one are two very different things. He did not start with a giant warehouse, a manufacturing facility, or a team of industry experts. In fact, his first challenge was figuring out how products like this actually get made. Most consumers never think about where detergent comes from. They see a bottle on a shelf and assume a massive corporation produces it somewhere behind the scenes. But Michael discovered that there were manufacturers across the country capable of producing formulas for smaller brands. That changed everything. Instead of spending millions of dollars building a factory, he could focus on creating a product and building a brand. His first step was talking to suppliers, learning about ingredients, testing samples, and understanding the differences between formulas. Some focused on stain removal. Others emphasized fragrance. Some prioritized environmentally friendly ingredients. Every decision affected cost, performance, and positioning. At the same time, Michael had to think about packaging. The bottle mattered. The label mattered. The brand name mattered. In a crowded market, consumers often make decisions in seconds. If the packaging failed to communicate value, many shoppers would never pick up the product in the first place. Like many entrepreneurs, Michael quickly realized that the product itself was only part of the business. The customer experience started long before anyone opened the bottle. After months of research and testing, he finally placed his first production order. It was not a massive order. He intentionally started small. That decision reduced risk and gave him room to learn. The goal was not to dominate the market overnight. The goal was to prove that real customers would actually buy the product. Then came the next challenge. Getting inventory is one thing. Selling it is another. Cases of detergent began arriving, and suddenly the business felt real. Money had been invested. Product was sitting in storage. Now every bottle needed a customer. Looking back, Michael often says the first sale was more important than the first production run. Manufacturing proved the product could exist. The first customer proved the business could exist. And when that first order finally came through, it validated months of work. But it also created a new question. If the product could be sold once, how could it be sold profitably at scale? For many entrepreneurs, revenue is the exciting number. But Michael learned very quickly that revenue alone does not determine whether a business succeeds. What matters is how much money remains after every expense has been paid. That is where the real story begins. At first glance, a bottle sitting on a store shelf may not seem particularly valuable. But when Michael started breaking down the economics behind each unit, he began to understand why so many companies were attracted to the category. Every bottle started with raw materials. Ingredients had to be sourced and blended into a formula. Then came packaging costs, including bottles, caps, labels, and shipping cartons. Manufacturing partners charged production fees. Inventory needed storage space. Products had to be shipped to customers or retailers. Marketing expenses had to be covered. Each step added cost before a single dollar of profit could be generated. Yet despite all those expenses, the numbers remained attractive when managed correctly. Michael discovered that even relatively small improvements could have a significant impact. A slightly lower packaging cost could improve margins across thousands of units. Better shipping rates could save substantial amounts over the course of a year. Increasing repeat purchases could dramatically improve profitability because existing customers were often less expensive to retain than new customers were to acquire. Over time, he became obsessed with understanding every dollar flowing through the business. Instead of asking how many bottles he could sell, he started asking how much profit each bottle produced. That shift changed the way he made decisions. Some opportunities that looked exciting generated very little profit. Others appeared smaller on the surface but produced much healthier returns. One of the most important lessons came from customer retention. The first purchase was valuable, but the second, third, and fourth purchases were often even more important. When customers continued buying month after month, the economics improved dramatically. A loyal customer could generate far more value over time than a one-time buyer ever could. This is why recurring demand became one of Michael's favorite aspects of the business. Every repeat order represented proof that customers trusted the product enough to purchase it again. But understanding the numbers also revealed a challenge that many outsiders never see. Attractive margins on paper do not automatically create a successful company. Because the moment sales begin growing, new problems appear. More inventory is needed. Larger production runs are required. Cash becomes tied up in stock sitting on shelves. And that is where scaling the business becomes far more complicated than simply selling more bottles. As sales increased, Michael encountered a reality that many new entrepreneurs underestimate. Growth can create as many problems as it solves. Selling a few hundred units is manageable. Selling thousands introduces an entirely different level of complexity. Suddenly, the business was no longer just about creating a product people liked. It became a game of operations, forecasting, logistics, and cash flow management. One of the first challenges involved inventory. Manufacturing partners often required larger production runs to achieve better pricing. On paper, ordering more inventory improved margins. In practice, it also required significantly more capital. Every pallet sitting in a warehouse represented money that could not be used elsewhere. If Michael underestimated demand, products could sit for months. If he underestimated growth, he could run out of stock and lose sales. Finding the right balance became a constant challenge. Supply chain management introduced another layer of complexity. Packaging materials came from different suppliers. Ingredients came from different sources. Production schedules had to be coordinated. Delays that seemed minor could create major disruptions. A shipment arriving a few weeks late could affect inventory levels, customer orders, and revenue projections. Then there was compliance. Consumer products require standards, testing, labeling requirements, and quality control procedures. Customers expect consistency every time they purchase. A formula that performs well today must perform the same way next month and next year. Building that consistency required systems, documentation, and attention to detail. Michael quickly realized that operational discipline was becoming one of the company's most valuable assets. Customer expectations also continued to rise. Fast shipping, responsive customer service, reliable inventory, and product quality all became part of the brand experience. A great formula alone was no longer enough. Every interaction influenced customer trust. As the business expanded, Michael spent less time thinking about individual bottles and more time thinking about systems. How could orders be processed more efficiently? How could inventory forecasting improve? How could operations scale without sacrificing quality? These questions became increasingly important as revenue grew. Ironically, many of the challenges that seemed intimidating when he first entered the industry were not what slowed companies down. Manufacturing could be outsourced. Packaging could be sourced. Marketing could be learned. The real challenge was building a business capable of handling growth without breaking under its own success. And while Michael was solving those operational problems, he began focusing on another question that would ultimately determine the company's future. In a market filled with similar products, how do you build a brand that customers remember and trust enough to buy again and again? The more Michael studied successful consumer brands, the more he realized that customers rarely buy products based solely on ingredients or technical specifications. If that were true, every company with a similar formula would perform the same. But they do not. Some brands create loyal followings while others struggle to gain attention. The difference often comes down to trust. When a customer stands in front of a store shelf or scrolls through dozens of options online, they are making a decision in seconds. They are asking a simple question: which product do I trust enough to bring into my home? That insight changed the way Michael approached growth. Instead of focusing exclusively on formulas and manufacturing, he started investing heavily in brand development. Packaging became more intentional. Messaging became clearer. Every touchpoint was designed to communicate a specific promise to customers. He wanted people to understand exactly who the product was for and why it existed. One of the biggest advantages smaller brands have is their ability to connect directly with consumers. Large corporations often communicate at scale. Smaller companies can create more personal relationships. Michael began listening closely to customer feedback, studying reviews, and learning what buyers actually valued. Some customers cared about ingredient transparency. Others cared about scent. Some wanted environmentally conscious packaging. Others prioritized performance above everything else. These insights helped shape future product decisions and marketing campaigns. He also learned that consistency builds trust faster than almost anything else. Customers do not want surprises when purchasing household products. They want the same experience every time. The same quality. The same performance, the same reliability. Delivering that consistency turned first-time buyers into repeat customers and repeat customers into advocates. Over time, word of mouth became increasingly important. Satisfied customers recommended the product to friends, family members, and coworkers. Positive reviews generated credibility. Repeat purchases strengthened the economics of the business. Every happy customer effectively became part of the company's marketing engine. Michael also embraced digital channels that allowed him to tell the story behind the brand. Instead of competing on price alone, he focused on explaining the values, mission, and customer benefits that made the company different. That approach helped create emotional connections in a category where many products appear interchangeable. Looking back, Michael believes building the brand was just as important as building the product itself. Because in a crowded market, customers do not simply remember what a company sells. They remember how it makes them feel. And as customer loyalty continued growing, the company reached a stage where local success was no longer the goal. The next challenge was figuring out how to expand beyond its original market and build something much larger. By this stage, Michael had proven something important. Customers were willing to buy the product, come back for more, and recommend it to others. But building a successful company in one market and building a scalable company across multiple markets are very different challenges. Growth required a new level of thinking. Early on, Michael was involved in nearly every decision. He reviewed inventory levels, monitored customer feedback, worked with suppliers, and tracked marketing performance. That approach worked when the company was smaller. It became a limitation as the business expanded. To grow, he needed systems that could operate without his constant involvement. The first step was standardization. Processes that once existed inside his head had to be documented. Supplier relationships needed structure. Inventory forecasting required more sophisticated planning. Customer service procedures had to be repeatable. Every successful company eventually reaches a point where systems become more important than individual effort, and Michael knew he had arrived at that stage. Distribution also became a major focus. Selling directly to consumers provided valuable margins and customer data, but it was not the only path forward. Retail partnerships created opportunities to reach entirely new audiences. Wholesale relationships opened additional channels. Each option offered advantages and trade-offs. The challenge was expanding without losing the brand identity that had helped attract customers in the first place. Cash flow management became even more critical during growth. Larger production runs required larger investments. More inventory meant more capital tied up in products waiting to be sold. Revenue was increasing, but so were operational demands. Michael learned that fast growth without financial discipline could create problems just as easily as slow growth. As the company expanded into new regions, customer behavior revealed another powerful advantage. The same factors that drove demand in one market often existed elsewhere. People still needed reliable household products. They still valued quality. They still appreciated brands they trusted. The business model proved more transferable than Michael originally expected. Looking back, one of the most important realizations was that scaling did not come from finding a completely new opportunity. It came from executing the same fundamentals repeatedly and consistently across a larger customer base. What began as a small brand serving a specific audience was gradually becoming something much bigger. And after years of growth, experimentation, and learning, Michael reached a point where he could finally answer the question every aspiring entrepreneur wants answered. If he had to start over from scratch today, what would he do differently? When Michael looks back at the journey, the biggest lesson is surprisingly simple. The opportunity was never hidden because it was complicated. It was hidden because most people ignored it. Like many entrepreneurs, he originally believed that successful businesses had to be innovative, exciting, or completely unique. Over time, he learned that some of the strongest businesses are built around products people already use every day. If he could start over today, he says he would spend less time searching for the perfect idea and more time understanding customer behavior. The breakthrough came when he stopped focusing on what he wanted to sell and started focusing on what people consistently needed to buy. That shift changed everything. He also admits there are mistakes he would avoid. Early on, he spent too much time trying to perfect small details that customers barely noticed. He underestimated how important speed of execution could be. He learned that gathering information is valuable, but eventually every entrepreneur reaches a point where action matters more than additional research. Another lesson involved branding. At first, he viewed branding as something secondary to the product itself. Today, he sees it differently. Products can be copied. Packaging can be copied. Marketing tactics can be copied. Trust is much harder to copy. Building trust with customers became one of the most valuable assets the company ever created. For anyone considering a business of their own, Michael's advice is straightforward. Do not overlook industries simply because they seem ordinary. Some of the largest opportunities are hiding inside products and services that people use every single day. Look for recurring demand. Look for customer problems that still need better solutions. Look for markets where trust matters. Most importantly, focus on building systems instead of chasing shortcuts. Sustainable businesses are rarely built overnight. They are built through consistent execution repeated thousands of times. In the end, the story is not really about detergent. It is about a principle that applies across countless industries. Extraordinary results do not always come from extraordinary products. Sometimes they come from seeing value where everyone else sees something ordinary, then building a system capable of delivering that value better than anyone else.